By the end of this video, you will know exactly how to invest your money without ever worrying about market timing again, and you will have a step-by-step plan you can start today with as little as $50. Most people spend years paralyzed by the same fear. They stare at their brokerage account, wondering if today is the right day to buy, terrified that the market will crash the moment they click that purchase button. Here is a number that should wake you up. A study from Dalbar found that the average investor earned just 2.5% annually over the past 30 years, while the S&P 500 returned over 10%. That is not because people picked bad stocks. It is because they tried to time the market and failed catastrophically. But before we get to the one psychological trick that separates wealthy investors from everyone else, something that can literally add hundreds of thousands of dollars to your retirement account, let us start with the basics. Today I am going to show you 3 things that will transform how you think about investing forever. First, you will understand exactly what dollar cost averaging is and why it works even when the market is falling. Second, you will see the real numbers comparing lump sum investing to dollar cost averaging, so you can make an informed decision for your specific situation. Third, you will learn the exact system I use to automate my investments, so I never have to think about timing again. Quick, if you have ever hesitated to invest because you were scared of buying at the wrong time, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who need to hear this. Let me paint a picture you probably recognize. You finally saved up a few $1,000s. Maybe it is your emergency fund overflow, a bonus from work or money you have been slowly accumulating in a savings account earning almost nothing. You know you should invest it. Every financial expert tells you that your money needs to be in the market to grow. So you open your brokerage app, hover over the buy button, and then you freeze. What if the market drops tomorrow? What if there is a recession coming? What if you are buying at the absolute peak? This fear has a real cost. Every month you delay investing $10,000 at an average 7% annual return costs you approximately $58 in lost growth. Over a year of hesitation, that becomes nearly $700 vanished. Over a decade of waiting for the perfect moment, you could lose tens of thousands. The tragedy is that the perfect moment never comes. There is always another headline screaming about inflation, interest rates, geopolitical conflict, or an impending crash. The financial media profits from your fear because scared viewers keep watching. But here is what nobody tells you. The most successful investors in history did not become wealthy because they timed the market perfectly. They became wealthy because they had a system that removed emotion from the equation entirely. That system has a name, and by the end of this video, you will know how to implement it yourself. Dollar cost averaging is the practice of investing a fixed amount of money at regular intervals, regardless of what the market is doing. Instead of trying to invest $30,000 at the perfect moment, you invest $1,000 every month for 30 months. The concept sounds almost too simple to be powerful, but let me show you why it works with real numbers. Imagine you have $300 to invest in a stock that costs $10 per share. If you invest all $300 at once, you buy 30 shares. Simple math, but now imagine you use dollar cost averaging instead. In month 1, the stock is $10, so your $100 buys 10 shares. In month 2, the stock drops to $5, and your $100 now buys 20 shares. In month 3, the stock recovers to $10, and your $100 buys another 10 shares. You now own 40 shares with an average cost of $7.50 per share. The person who invested everything in month 1 owns 30 shares at $10 each. You own 40 shares at an effective price of $7.50. When the stock eventually rises, you will make significantly more money. Here is where most people get this wrong. They think dollar cost averaging only works in falling markets. Actually, the strategy reduces your risk and smooths your returns regardless of market direction. The fix is understanding that dollar cost averaging is not about maximizing returns. It is about maximizing the probability that you will actually invest consistently over time. But here is what nobody tells you about the academic research on this strategy. Multiple studies, including famous research from Vanguard, have shown that lump sum investing beats dollar cost averaging approximately 2/3 of the time. If you have a large sum of money and you invest it all immediately, historical data suggests you will end up with more money than if you spread it out. So why would anyone choose dollar cost averaging? Because those studies assume something critical. They assume you will actually invest the lump sum. They assume you will not panic and sell during the next correction. They assume you have the emotional fortitude to watch your entire investment drop 30% and do nothing. For real humans with real emotions, dollar cost averaging provides something the academic models cannot measure: peace of mind. A study from UCLA found that investors who used dollar cost averaging were 67% more likely to stay invested during market downturns compared to lump sum investors. Staying invested is everything. Missing just the 10 best days in the market over a 20-year period can cut your returns in half. Stop. Before I continue, this next part is critical. We need to talk about when dollar cost averaging makes the most sense and when you might want to consider alternatives. Dollar cost averaging is ideal in 3 specific situations. First, when you are investing money as you earn it. If you get paid every 2 weeks, investing a portion of each paycheck is natural dollar cost averaging. You cannot lump sum invest money you do not have yet. Second, when you receive a large windfall and feel anxious about investing it all at once. Maybe you inherited $50,000 or received a significant bonus. If the thought of investing it immediately keeps you awake at night, spreading it over 6 to 12 months removes that psychological barrier. Third, when markets are at all-time highs and you feel nervous about valuations. Even though markets at highs often continue climbing, dollar cost averaging can help you take action instead of waiting on the sidelines forever. Here is where most people get this wrong. They use dollar cost averaging as an excuse to procrastinate indefinitely. They say they will invest over 12 months, then 24 months, then they keep extending the timeline. The fix is simple. Decide on your investment timeline before you start and automate it so you cannot talk yourself out of it. This next section changed everything for me when I finally understood it. We need to discuss the hidden cost of holding cash while you dollar cost average. Money waiting to be invested is usually sitting in a savings account or money market fund earning modest interest. Meanwhile, the market has historically risen about 70% of the time on any given day. Every dollar waiting to be invested is a dollar not participating in that upward drift. Let me give you specific numbers. If you have $60,000 and you choose to invest $5,000 per month over 12 months, you're keeping an average of $30,000 out of the market for the entire year. At a 7% expected return, that cash drag costs you approximately $2,100 in expected growth. Is that cost worth the psychological comfort? Only you can answer that question. For many people, especially those who would otherwise never invest at all, the answer is absolutely yes. $2,000 in theoretical opportunity cost is meaningless if the alternative was leaving $60,000 in a savings account for 3 years, because you never felt confident enough to invest. I need to pause here because this is where most people go wrong. They treat dollar cost averaging and lump sum investing as an either-or decision when the smartest approach is often a hybrid strategy. Here is what I mean. Take half of your available funds and invest them immediately. This gets you market exposure right away and takes advantage of the statistical edge that lump sum investing provides. Then dollar cost average the remaining half over the next 3 to 6 months. This hybrid approach gives you the best of both worlds. You participate in immediate market gains if they occur, but you also have cash ready to deploy at lower prices if the market drops. Research from AQR Capital Management found that this approach captures approximately 85% of the lump sum return advantage while providing significant psychological comfort during volatile periods. If you have made it this far, you are already ahead of 95% of people, and what I am about to share in this next section is the most valuable part of this entire video. Do not skip it. Subscribe to Wealth Decode Plus if you have not already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Let me show you exactly how to implement dollar cost averaging in your own life starting today. The key is automation. Willpower is a limited resource, and every decision you have to make about investing is an opportunity for fear to take over. Here is your action plan. Today, in the next 10 minutes, I want you to do one thing. Log into your brokerage account or open one if you do not have one yet. Fidelity, Charles Schwab, and Vanguard all offer excellent free options. Set up automatic recurring investments. Every major platform allows you to schedule automatic purchases of index funds or ETFs on a weekly, bi-weekly, or monthly basis. Choose an amount you can sustain long-term, even if it is just $50 per paycheck. This week, I want you to calculate exactly how much you can invest each month without impacting your emergency fund or essential expenses. Look at your last 3 months of spending. Find the average amount left over after necessities. Commit to investing at least half of that automatically. This month, I want you to build what I call your investment ladder. Set up automatic investments on 3 different dates throughout the month. If you invest $300 monthly, schedule $100 on the 1st, $100 on the 15th, and $100 on the 25th. This micro-dollar cost averaging smooths your entry points even further. The specific tools I recommend are simple. For taxable brokerage accounts, use M1 Finance because they allow you to set up automatic investments into custom portfolios called PIEs. For retirement accounts, use whatever your employer's 401k provider offers and max out any employer match immediately. That match is free money, an instant 100% return that no investment strategy can beat. For IRAs, Fidelity offers zero expense ratio index funds, meaning 100% of your money goes to work for you. Now let me answer the question I planted at the very beginning. What is the one psychological trick that separates wealthy investors from everyone else? It is this: wealthy investors remove themselves from the decision-making process. They understand that their emotions are their biggest liability. Fear makes them want to sell at market bottoms. Greed makes them want to buy at market tops. The solution is not to become emotionless. The solution is to automate your investments so emotions never get a vote. Dollar cost averaging, when automated, transforms investing from a series of stressful decisions into a boring background process. And boring is exactly what you want your investments to be. Let me summarize the 3 key takeaways from today. First, dollar cost averaging means investing fixed amounts at regular intervals, and it works because it removes the impossible task of timing the market. Second, while lump sum investing statistically wins more often, dollar cost averaging wins in the real world because it dramatically increases the odds that you will actually stay invested through volatility. Third, the power of this strategy comes from automation, so set up your recurring investments once and never think about timing again. Comment below and tell me which of these 3 strategies you are going to try first. Are you going full dollar cost averaging, trying the hybrid approach, or committing to automation for the first time? I read every single comment, and I will personally reply to as many as I can. In tomorrow's video, I am revealing the exact portfolio allocation strategy that minimizes your risk while maximizing long-term growth, something that took me years to figure out and most people never learn. Subscribe right now so you do not miss it.